If a narrow, like 2-mile stretch of water in the Middle East gets blocked today, within a week, millions of families in India won't be able to turn on their stoves to cook dinner. And simultaneously, your favorite pair of jeans will likely get significantly more expensive.
Yeah, I know it sounds like an exaggeration, but the global economy is just wired so tightly that a single blocked artery causes symptoms in places you would never intuitively expect.
Right. So welcome to today's deep dive into the source material. We are looking at exactly how fragile that wiring actually is, whether you're analyzing supply chains for a living or trying to make sense of the wild headlines, or you're just wildly curious about the hidden mechanisms running our world. You are in the right place,
Absolutely.
because we have a really fascinating, deeply interconnected stack of sources for you today.
We do. We're pulling from a highly detailed March 2026 oil market report by the International Energy Agency, the IEA. We also have a breaking news report from investing.com that tracks an incredibly tense geopolitical standoff unfolding right now in the Middle East. And then to cap it all off, we have the Q1 2026 earnings press release from Levi Strauss Co.
I know, putting a military standoff next to a denim company's earnings report sounds completely random.
It really does.
But the mission of this deep dive is to explore the hidden, cascading ripple effects of global choke points. We are going to map out exactly how a crisis in a single waterway forces massive changes in everything from macroeconomic inflation to, well, corporate retail strategy.
Yeah, it's all connected.
Before we dive in, though, a quick note. We're looking at some intense breaking geopolitical news today involving the U.S. and Iran. And our mission here isn't to play politics, endorse viewpoints, or take any sides.
Right, exactly.
We're strictly looking at the raw data, the direct quotes, and the economic ripple effects as they appear in the sources, just to understand how this rewires global trade.
Yeah, our objective is to dissect the mechanics of the crisis impartially. Nothing more.
Okay, let's unpack this. We have to start with the epicenter. According to the IEA report, we are currently witnessing the largest supply disruption in the history of the global oil market.
Which is just staggering to think about.
It is. The Strait of Hormuz is essentially at a standstill. Normally, nearly 20 million barrels per day of crude and petroleum products pass through that strait. Today, it's plunged to a mere trickle.
And we really need to pause on that number. 20 million barrels per day, that is roughly 20% of total global oil consumption.
Wow, 20%.
Yeah, it is the lifeblood of industrial economies, and having it suddenly erased from the map induces immediate cardiovascular shock to the global system.
And the political rhetoric surrounding this is escalating at a terrifying pace. Based on the investing.com report, President Trump has issued a severe ultimatum to Iran.
Right.
The direct quote from the report is a warning that a whole civilization will die tonight unless Iran guarantees the reopening of the strait by an imposed deadline.
Yeah, very intense wording.
And it's moving past rhetoric, too. The U.S. reportedly conducted over 50 strikes on military targets located on Iran's Karg Island.
And Iran's response has been equally severe. Through the Tasnim news agency, Iranian military sources have explicitly warned that oil prices could skyrocket to $200 a barrel.
Which would be catastrophic.
Exactly. Furthermore, they've threatened to close the Bab el-Mandeb waterway, which is, the other critical global choke point connecting the Red Sea to the Gulf of Aden.
Right, so locking down two major maritime arteries.
Yes. But most critically for the energy infrastructure, they threatened to target Saudi Aramco facilities, the Yanbu oil facilities, and the Fujairah pipeline.
Wait, looking at the map for a second, Saudi Arabia has the East-West pipeline, right?
They do, yeah.
It's the one that runs over to the Red Sea. Why can't these countries just divert the oil through pipelines like that and skip the Strait of Hormuz entirely? I mean, it seems like there should be a side door.
That's the logical assumption, and those side doors do physically exist. The IEA report actually details them. Saudi Arabia's East-West pipeline, also known as Petroline, runs to the Red Sea port of Yanbu and has a capacity of about 7 million barrels per day.
Okay.
And the UAE also has the Adi-Kakap pipeline, which bypasses the strait and goes to Fujairah on the Gulf of Oman, and that handles about 1.5 to 1.8 million barrels per day.
Right, so combined, that's nearly 9 million barrels a day. That's a massive amount of oil bypassing the strait.
It is. But if we connect this to the bigger picture, 9 million cannot fully replace a 20 million barrel void.
Oh, right. You're still way short.
You are still missing 11 million barrels a day. But more importantly, let's look at the specific threats Iran issued. They explicitly named Yanbu and Fujairah as targets.
Oh, the very facilities designed to act as the bypass.
Precisely. The side doors are theoretically open, but you have to walk through a designated minefield to use them. The infrastructure designed to create resilience is now directly in the crosshairs.
That paints a really grim picture for global crude. But the IEA report makes it clear that the fallout goes way beyond, like, the gasoline in your car.
It really does.
Let's actually look at what this means on the ground for millions of people. It's about a hidden supply chain of petrochemicals and liquid petroleum gas, or LPG.
Yeah, this is where the macroeconomic abstraction becomes a very real human crisis. The Gulf exports roughly 1.5 million barrels per day of LPG and 1.2 million barrels per day of naphtha.
And naphtha is used for what exactly?
Naphtha, for context, is the essential building block for global plastics and manufacturing. If naphtha stops, factories stop.
But the LPG data is what's truly alarming to me.
Absolutely.
According to the IEA, India absorbs almost 45% of the Middle East Gulf's LPG exports. And 90% of that supply isn't going into industrial manufacturing. It is going directly to domestic heating and cooking.
Right.
We're talking about millions of Indian households relying on this specific maritime route to physically cook their meals.
And here is the underlying mechanism that makes it so dangerous. India's supply chain for LPG is incredibly short.
What do you mean?
Well, the maritime journey from the Strait of Hormuz to the west coast of India takes less than a week. Because it has historically been so fast and so reliable, India operates on a just-in-time delivery model for cooking fuel.
Oh, I see.
Yeah, they do not have massive underground strategic reserves of LPG waiting for an emergency. So when the cargo ships stop sailing out of the Gulf, that disruption hits Indian kitchens almost immediately.
Wow. That is the ultimate vulnerability of a highly optimized supply chain.
It really is.
And the disruptions are spreading upwards, literally into the skies. The IEA noted a 40% drop in Middle Eastern jet fuel demand because massive numbers of flights are being abruptly canceled or rerouted to avoid the conflict airspace.
And those ripple effects are forcing some rapid geopolitical pivots. Because India's vital Middle Eastern supply lines are severed, they're desperately pivoting back to Russian oil.
Right. I read that the U.S. actually had to grant a 30-day waiver to allow India to purchase Russian crude that was already on the water.
Yeah, they did.
And the irony here is just striking. This is happening right after Russia's total export revenues had just plunged to a fresh low of $9.5 billion in February due to global sanctions. A crisis in the Middle East suddenly throws a financial lifeline to Moscow.
Which perfectly illustrates how energy markets behave like a fluid dynamic. You know, when you block one channel, the pressure forces the fluid down the path of least resistance, completely regardless of previous political sanctions.
Well, speaking of pressure valves, the IEA member countries unanimously agreed to release a historic 400 million barrels of oil from their emergency reserves.
Right, which is unprecedented.
It sounds like an overwhelming response. 400 million barrels is huge. But let me challenge the actual mechanics of that. If the strait is blocked, is releasing oil from reserves in Texas or Europe actually going to solve the logistical crisis, or is it just a massive fire extinguisher for a problem that isn't a fire?
That's the perfect question, because the physical oil isn't the actual bottleneck right now.
It's not.
No. Yes, global observed oil stocks are at their highest level since February 2021, over 8.2 billion barrels. So the physical cushion exists. But releasing emergency reserves is only a stopgap measure because of how maritime shipping works.
You mean the ships won't move?
Exactly. Releasing oil from a stockpile doesn't help if the commercial ships in the Middle East refuse to transport it. It's like having a warehouse full of fire extinguishers, but the delivery drivers are on strike because the roads are mined.
Oh, wow. That's a great way to put it.
According to the IEA, the International Transport Workers Federation upgraded the region to a warlike operations area.
And what does that mean legally?
That designation means seafarers have the legal right to refuse to sail into those waters. On top of that, maritime insurance syndicates freeze. War risk premiums have skyrocketed, and in many cases, coverage has been canceled entirely.
So no insurance, no sailing.
Exactly. Without insurance and without physical military protection, commercial cargo vessels will simply drop anchor and refuse to sail.
So the plumbing is physically intact, but the legal and financial mechanisms that allow the water to flow have completely seized up.
Yes.
Which explains the desperate scramble we're seeing on the diplomatic front. Investing.com is reporting breaking news that Pakistan is stepping in to mediate.
Right.
They're actively asking President Trump to extend his deadline by 2 weeks, while simultaneously calling for a 2-week ceasefire from all parties just to give diplomacy a chance to breathe.
And you can track the sheer anxiety of the global market just by looking at the price charts.
The oil prices.
Yeah. Brent crude, which is a global benchmark for oil prices, soared to nearly $120 a barrel on the initial news, before settling back around $92 as hopes for mediation surfaced.
That is a wild swing.
It is. Meanwhile, Urals crude, which is Russia's main export blend, jumped to $58.29 a barrel, precisely because desperate buyers like India are pivoting to purchase it.
Okay, so oil is reacting, but what about the broader markets?
Well, global stock markets managed to eke out a marginal gain, but analysts made it very clear this was strictly based on the fragile hope that Pakistan's mediation might actually succeed.
So we see the chaos at the macro level. But if you're running a business right now, or even just managing your household budget, the real threat here isn't just the price of a gallon of gas.
No, not at all.
The real threat is the systemic economic contagion. So what does this all mean for the listener's wallet? We know oil drives up gas prices, but how deep does this economic contagion go?
What's fascinating here is the data hidden deep in the macroeconomic reports. The U.S. services sector is already showing significant signs of strain.
Really? Already?
Yeah, it is expanding at a slower rate, and employment in that sector actually contracted. But the ultimate red flag is the prices paid index.
For those who might not follow economic indicators daily, what exactly does the prices paid index measure?
It measures the costs that businesses are paying for raw materials and services. It is a leading indicator of inflation because, when businesses pay more, they eventually pass those costs on to you, the consumer. And that index just spiked to its highest level since October 2022.
Meaning inflation is accelerating behind the scenes.
Exactly. The underlying mathematical fear is this. Historically, a sustained 10% increase in benchmark crude oil prices curtails global GDP by roughly 0.15%.
Because it touches everything.
Right. Oil is an input cost for literally everything: manufacturing, transportation, agriculture. When the price of crude spikes, it acts as a massive regressive tax on the entire global economy. Inflation is the ghost haunting every single one of these geopolitical maneuvers.
So if we step back, we have a global environment defined by blocked maritime choke points, spiking raw material costs, and looming stagflation.
Yeah, it's pretty bleak.
How does any business survive that? This brings us to our final source, which shifts us from the macro chaos of the energy sector to a micro example of corporate survival. Let's look at the Q1 2026 earnings release from Levi Strauss Co.
It's a jarring pivot, but it is a masterclass in structural resilience.
It really is.
Yeah.
Because despite the absolute chaos we just mapped out, the threatened supply chains, the macroeconomic pressures, the inflationary spikes, Levi's just reported a monster quarter.
They really did.
They hit net revenues of $1.7 billion. That's up 14% on a reported basis and 9% organic. Their diluted earnings per share came in at $0.45. Their Beyond Yoga brand grew by 23%.
That's huge.
And they operating with such confidence that they actually raised their full-year revenue outlook to between 5.5% and 6.5%.
And they achieved all of this despite taking direct heavy hits from the global trade environment.
Wait, they did?
Yeah. If you dig into their margins, their gross margin dipped slightly to 61.9%. The primary culprit was tariffs. They are currently absorbing 30% U.S. tariffs on imports from China and 20% on imports from the rest of the world.
Wait, 30% tariffs on goods coming out of China? How do you absorb a 30% tax on your core product and still raise your revenue outlook? I mean, they must have just hiked their prices on the consumer.
Partially, yes. They offset some of it with price increases and running fewer promotions.
Okay.
But the real mechanism behind their success, the reason their Chief Financial and Growth Officer, Amidst, is able to retire on such a high note this quarter is how they fundamentally restructured their business model.
Okay, here's where it gets really interesting. It's their direct-to-consumer, or DTC, strategy.
Exactly.
According to the release, DTC revenues increased by 16%, and now make up a massive 52% of their total net revenues. They completely sold off their Dockers brand just to focus on this.
Right.
They are transitioning from selling bulk wholesale to department stores to selling directly to you through their own stores and websites.
Precisely. They are executing what their CEO calls a DTC-first denim lifestyle brand strategy.
But hold on a second. Let me push back on this because I want to make sure the connection is clear for our listeners.
Sure.
We've been talking about physical supply chains.
Yeah.
DTC bypasses the retail store, sure. But those jeans are still manufactured in Asia. They still have to cross an ocean on a cargo ship.
Yeah, they do.
A slick e-commerce website doesn't solve a blocked maritime trade route or a spiked insurance premium. In a world where global choke points are failing, how does DTC actually protect them from the macro chaos?
That is the critical distinction. You're completely right. DTC does not physically bypass a blocked ocean. The jeans still go on a boat.
Right.
What DTC does is bypass the economic margin choke point.
Ah, okay. Explain how that works.
Think about the traditional retail model. When Levi's sells a pair of jeans wholesale to a massive department store, they have to sell it at a steep discount so the department store can mark it up and make a profit.
So they split the pie.
Exactly, they split the pie.
Yep.
But when Levi's sells directly to you through their own website or branded store, they keep the entire pie.
Oh, I see.
That significantly higher profit margin acts as a financial shock absorber.
So when a geopolitical crisis hits and shipping costs double, or a 30% tariff is slapped on imports from China, Levi's has the financial padding to absorb that blow.
Exactly. Because they own the channel, they control the pricing power, the inventory, and the customer relationship.
They don't have to negotiate with a panicked middleman retailer.
Right. They have built an economic buffer that allows them to weather the exact kinds of global storms and inflationary pressures we've been discussing without having to hike the price to a point where the consumer simply refuses to buy.
That makes perfect sense. In a world where physical pipelines and shipping straits are incredibly vulnerable, Levi's essentially built a financial bypass route.
They really did.
By cutting out the middlemen, they constructed a direct pipeline straight into the consumer's closet, giving them the margins required to survive a fragile global supply chain.
It is corporate resilience built through structural margin independence.
So let's bring all these threads together. We live in a hyper-connected ecosystem where a single blockage creates cascading systemic shock. A geopolitical standoff that traps cargo ships and a 2-mile-wide stretch of water in the Middle East immediately threatens to extinguish cooking fires for millions of families in India.
Right.
It grounds airplanes across Europe. It causes the prices paid index to spike, threatening to infect the U.S. services sector with crippling inflation.
It touches everything.
And in response to this volatile, unpredictable environment, legacy brands like Levi's are forced to completely rewire how they generate profit, bypassing traditional retail networks entirely just to build the financial armor needed to survive the chaos.
It's a fascinating study in cause and effect, and it raises a critical question that I'd like to leave the listener to mull over long after this deep dive ends.
What's that?
For the last 50 years, we have built a modern world optimized entirely for maximum efficiency. Just-in-time shipping, concentrated mega refineries, massive cargo ships squeezing through narrow straits.
Right, all to keep costs down.
Exactly. We removed all the slack from the system to save money. But as we look at the terrifying vulnerabilities of the Strait of Hormuz today and contrast that with the financial success of Levi's pivot to protect its margins well, we have to ask, is the future of global business really going to be about maximizing efficiency? Or is the new era going to be defined by bypassing these choke points altogether to build local structural resilience?
Wow. When the circulatory system of the global economy is this fragile, maybe efficiency is actually the biggest liability of all.
Exactly.
Thank you for joining us on this deep dive into the source material. We hope this gave you a new lens through which to view the headlines. Stay insanely curious, keep looking for the hidden wiring in the news, and keep questioning the connections around you. Until next time.